We're going to be specifically dealing with the secrets to high reward trading setups. Now, some of you may have already went through my trading plan development series. It was a long video series that has a lot of information. It was really aimed for those individuals that have never really had exposure to the marketplace, giving them ideas on what direction to go and what to focus on primarily. And while it is a great deal of information for a neophyte, it is necessary to go through those things because it has to give you, well, not it doesn't have to, but when you're first starting out, it's important that you have a mentor or you have a framework or a foundation to build upon to give your trading career a direction. One of the most reoccurring themes in my role as a mentor is, where do I begin? What should I do first? Where should I be focusing my attention at now? What should I be studying? Okay. And while the trading plan development series is still good, it's still valuable in my opinion, not because I made it, but because it's useful. Some of you, majority of you actually, are actually really exposed to my content and my material as it relates to trading, specifically to foreign exchange. But I think that if one were to look at what I actually do on a day-by-day basis, what is the procedure, what are the things that I do to elect a specific stance on the marketplace, what makes me bullish, what makes me bearish, why do I focus on one currency pair over another. All those things are decisions and processes. And while we will have specifics in relationship to how I arrive at individual specific views or decision points as relates to how everything fits together in my decision process, it's important that we start with kind of like a micro version of the trading plan development series in this teaching. That's what this is. While it's not going to be comprehensive as the trading plan development series was, this one's going to be a little bit more specific. It's going to be more salient to the things that I do as a specific Forex trader. I don't look at all of those things that the trading plan development series video course spoke about. They do occasionally come up in my thought processes, but they're not all required to come to a trade decision. Okay, so we're going to go through a lot of the things that I believe that if you've been exposed to at least all my free tutorials, we're going to be able to get down to a little bit more process and decision-based parameters in this teaching. Now, it's important also that we go into this with the proper mindset. Okay, I don't want anybody thinking we're going into trade signals. We're not talking about trading patterns. We're not talking about stop loss placement or trade management. None of those things are important here. This is the last primer for us before we start going into the specifics of breaking down individual decisions, each process, which as a collective whole, as we'll discuss in this teaching, you'll see that that's how the ICT mindset is. What we do on a day-by-day basis, what frames our opinion about certain things, and when do we change those opinions, and when do we move to the sideline. All those things come by way of process thinking. Okay, and it's important that you understand that while entry signals and stop placement and patterns and order blocks and order flow and all the ICT jargon and the things that get really exciting, there's got to be a little bit of dry information presented to you, and it's important. So I don't want you to look at this video and go through it and walk away with, well, this isn't really teaching me anything. It really is teaching you. It's going to teach you how, number one, to think in terms of foundations, because we have to understand where we're building on to elect a decision relative to whether we're going to be a buyer or seller, or where we're going to stay in on the sidelines. Okay, because that's the real secret to trading, understanding what makes the process arrive at a decision. Okay, what is the process? What are the components that help you arrive at whether you should be a trader buying or selling or staying on the sidelines, and what asset class should you be trading, and what specific pair if you're going to be dealing with foreign exchange as we are in this teaching. All those things will be a little bit more clear, a lot more clear, I should say, by having the thought processes that I'm going to introduce here. Now, obviously, there has to be a specific order. Okay, there's got to be an hierarchy to what it is that we do as a trader, what makes our decisions, incremental. What do we do first? What do we focus on first? And obviously, I've been a strong supporter of the notion that every trader needs to have patience, obviously. And after patience, then we have to understand, obviously, what defines trade environments. Are the environments conducive for trading right now? That's a topic that obviously goes largely untaught by majority of everyone that's teaching and has courses or whatever they do in terms of teaching the populace. And I do a lot of work with that in this mentorship, and it's going to be a lot more spread across the entire mentorship. So I don't really have one specific teaching that talks about when you shouldn't trade. There's going to be a lot of things that you'll come by experience and learning that define those environments. Okay. The next stage is obviously to determine a trade parameter. What makes your trading, a buy or sell? What gives you those notions to even take action? Obviously, it's not simply, well, it's been going up for the last 60 minutes, so I'm going to buy, or it's going to be going lower because of an interest rate announcement. I believe that's going to happen, so therefore I'm going to, trade on that. It has to be very defined. Okay, it has to be specific. It has to be binary. You do this or you don't do this. Okay, do X or do Y. Okay, it has to be a very black or white decision process. If you don't have your trading plan or your perspective or process, in determining whether you want to be a trader buying or selling right now or staying on the sidelines, it will create a huge vacuum where lots of emotional, psychological, and impulsive trading will creep in. And if you don't have these binary thought processes and where you're specifically dealing with in terms of decision making, you won't have any structure. And without structure, without having a refined, clear trading model, what defines your trading, what makes your trading model uniquely yours, you're going to struggle. And it doesn't matter who teaches you, it doesn't matter what principle or discipline you trade with, it's going to be an impossible endeavor if you do not become highly organized. So you have to, after a long period of time spending in front of charts and work with individuals and myself as a trader, because I'm always a student, I'm always learning something about myself as a trader, not so much about the market anymore. And I don't mean to sound arrogant, but most of my learning comes by way of my individual experience as a trader. And you'll learn that actually helps you refine your trade parameters. And next, obviously, you need to know what makes your executable criteria what it is, what makes you be the buyer or the seller. And having those parameters defined, it's not just simply I'm bullish right now. Okay, well, if you're bullish, what would you do to be a buyer, and what would make that buying scenario negated? What would change the tone in the marketplace for you to either move to the sidelines, or if you have a stop loss hit, do you still consider that being a buying condition? These things have to be specific. They have to be highly refined. It's got to be like a flowchart format. You have to go from one step to the next. And if it's not like that, again, you're going to be very emotional. You're going to be very psychologically influenced by the things that you see in the price action, and worse, by online media, forums, Twitter, Facebook, people talking to you and you're at work, and your friends that that are traders. All those things are going to be influential to you, and it's going to be detrimental to your performance as a trader. So we don't care what anybody else's opinion is. We don't care about what their opinion of our trading model is. In fact, we're not really trying to share our trading model with anybody. It's a unique trading plan and trading model for you. Okay, and you're going to define that, refine it to yourself. And that's going to be your graduation, when you know exactly what's going to be framing your trading model. and you'll have a lot of help along the way through the remaining months of this mentorship, but they have to be defined by you. I can't force you to be a day trader. I can't force you to be a short-term trader. I can't force you to be a swing trader. You'll know which one that is for you by the end of this mentorship. And then more importantly, you have to understand why the trade should pan out. Understand what makes the trade viable. Okay, it's not just simply I see a trading pattern here, or I believe I'm bullish, or I believe I'm bearish from the marketplace. There has to be a real understanding of why that scenario should take place. And largely this is going to come by experience. Okay, and obviously that experience comes by taking action in a demo account. And when you do, that experience should be logged and kept for future reference. That's the only way you're really going to learn. Obviously, if you just go into a demo account and you click on buy and sell and you're just waiting to see the outcome, and you want to attribute the winning trades as you're a good trader and the losing trades, well, that really didn't happen, so therefore it doesn't make a difference to me, that doesn't help you as a developing trader. So the real secrets to finding high reward trade setups is that number one, you have to know what it is specifically you're looking for and where to find that information. So before we get into all those things, I want you to understand that it's crucial to understand that efficiency in trading comes by way of process-oriented thinking. And it doesn't come by way of reactionary or impulsive thinking, which also leads to rushing ahead and trade signals prematurely. I could tell you if we were all going to sit over top my email box and look at some of the things that I got and by way of feedback, it's the reoccurring thing is I want to see trades. I want to see entries. I want to see get me in and get me out, that type of perspective. And I understand that. I get that. Okay. But I can tell you, being from where you are right now and where I am now, and my understanding as a trader, I can tell you that's not what you need to know right now. And it doesn't feel good to hear that. It feels like I'm leading you down the primrose lane. It feels like I'm just, deferring, something that you think you need to have right now. And that's not true. What it is you have to develop a process-oriented thinking. And that means I can show you order blocks. I can show you breakers. I can show you institutional order flow returning back to a mitigation block. Okay, I can show you examples of that. But until you understand the process behind why these things should be doing what they're going to do, it's going to be really of no help to you. It's going to feel like I'm demonstrating toys. It's going to feel like I'm, showing you, well, this is what I can do. And that's not what this is all about. It's to show you with an intimate experience on a day-by-day basis, a weekly basis, a teaching tutorial basis, a theme generalized over the month, okay, that builds on your total understanding. The folks that are struggling right now are the folks that are really trying to be reactionary, or they're impulsively thinking about what they want to do right now. And that's the hardest thing for traders to do when they first get involved with learning. They have this insatiable desire. They have to be trading right now. They want to get in. They want to take signals. Okay. And I spent the entire first month, September, on a day-by-day basis showing you that there are a plethora of trading signals all the time. We were laser guided precision. There's no reason for you to be feeling rushed. Like October didn't change, okay, the way price is being delivered. None of these concepts fell out of fad. Okay, it still works. But I needed to show you the first month that there's nothing that's going to hinder your ability to find signals, because there's always a lot of them. The problem's going to be is you don't know what defines the setups for you as a trader, and you're not going to have a process-oriented thinking that leads you to high reward trade setups. And it comes by experience. It comes by showing you conceptual ideas and a broad brush idea of breaking down what it is that we look for in the marketplace and where does that information reside. So it's real important before we get into this that this is important that you focus on the fact that what I'm showing you in this teaching, while it doesn't give you technicals, it doesn't give you trade scenarios, it doesn't give you specific get in, get out type things. I'm of the mindset that this is exactly what I needed to be told when I first started as a trader, but no one was around to tell me these things. No one had the experience around me, or I had the avenue of reaching them like you have with me. You have a very intimate relationship with me as a mentor because I'm spending a great deal of time, and I'm investing a lot of my time by way of my experience. And it takes a lot of time to communicate that because we're talking about someone that's been doing this for 2 decades or more. And there's a lot of lessons I learned, and there's a lot of lessons that I resisted initially. And some of those are the same things I'm warning those individuals that are feeling it right now. And you know who you are, because right now you're squirming. You're wanting to get on with it, Michael. If you're feeling that, you're in that reactionary impulsive thinking. Okay, you need to change that, suppress that. It's hard. I know it's hard, but you're not going to get to high reward trading scenarios, okay, that you can find very quickly in the marketplace, that you can find consistently, efficiently. All those things are going to evade you because you're looking to do something right now. And professional traders are not in a rush to put money at work. They want to sit back and wait for a scenario that makes sense. So if we were all in a room and everyone had a chance to ask me something, I can tell you the number one reoccurring question, if we were all to write it down on a piece of paper ahead of time, not just vocally say it, that way no one would basically repeat it. The question would come by way of, what makes me think this order block's going to do what? Or what makes me think that this level is going to keep price from going higher? Or why do I think the Judas swing should go up after midnight and then sell off? What are all those things? And I understand why you're asking those questions, and they're the same types of questions that I had about the marketplace. But again, I didn't have anybody to direct those questions to. But it's important that you understand that there's no way I can actually answer that question to you now, because we haven't gone through all the things that are necessary for me to adequately answer that. It's almost like I'm creating an additional language on top of what you've already arrived at by going through my free tutorials. And that's why I require 12 months with me, because it's going to basically beat it in your brains by hearing it over and over again, specifically dealing with it on a trade by trade basis, a daily involvement, the application of it. And that's going to be, the big takeaway. You're going to have experience, whereas if I just wrote a book, or if I made some DVDs or CDs and you watched them, that would be it. It would be rather stilted. You would come away with, well, that's cool, I can see how it works sometimes, or I can see how it works in the past. But you don't have the intimate relationship of sitting down and going through the process, okay, and then explain why it should take place. We did some of that on a micro scale in September, but we need to go through a process of outlining, what the beginning foundations are going to be, because as we go into the 4th, 5th, and 6th month, they're going to be greatly focused on the components that make up the trade templates. Okay, in other words, at the end of your mentorship, you're actually going to get a flow chart for when to be a buyer for swing trades, when to be a seller for swing trades, every specific decision point that goes through my head as a trader, and what tools you use for each decision point, and what's the response that you should have. Everything that we use, everything that I go through in my tools, for short-term trading, the same way. What makes me be a buyer? What makes me be a seller? What makes the trade no longer good? Where does my stop go? When do I move my stop? All those decisions that go through my my mental process. Okay, because everything I do is process-oriented thinking, and it comes across as, well, you're just really good at this, and it's not that I'm good at it. It's just I'm experienced at it, and I know what decision I need to make right now. And sometimes it's sit on the sidelines. And because I've done it so long, that experience gives me reference to go to mentally, and it only takes a few seconds sometimes to arrive at where I think the market's going to go based on these processes. Now, while it seems like it's a great deal of information, and I'm jawboning here, it's important that you really, really listen. So if this is one of those videos, because there's no charts here, you need to sit down and listen. Don't be watching TV. Don't be having your kids in the sidelines, okay, distracting you. You need to be paying attention to this one because it's important. Okay, so let's take a look at how we go about this using the tools and all of the processes along the lines of ICT related information. Obviously, again, we're not talking about the trade plan development series. Okay, it's just like a micro scale version of all that stuff. So we're going to go right into where the information is going to reside and what you're going to be looking for in these specific areas of study. Before we get into any high reward trading setup, we have to understand, obviously, there's going to be a big picture perspective. Okay, and when I say big picture perspective, it's primarily 4 areas of reference. It's going to be macro market analysis. It's going to be interest rate analysis, intermarket analysis, and seasonal influences. The next area of study is going to be for an intermediate perspective. We're going to be looking at top-down analysis, COT data, which is commitment of traders, and market sentiment. And for our short-term perspective, we're going to be looking at correlation analysis, time and price theory, and IPTA, which is the interbank price delivery algorithm. Now, looking closer at the big picture perspective, we're going to take a look at what makes up our big picture perspective. Obviously, there's 4 areas of study, and again, macro market analysis, interest rate analysis, intermarket analysis, and seasonal influences. A little bit of a tongue twister there, folks. When we look at the big picture perspective, okay, while there's 4 areas of study, we're going to need to primarily focus on at least 2 of these that have to come into agreement. Okay, what I mean by that is our macro analysis, our interest rate analysis, our intermarket analysis, and seasonal influences. All 4 of these do not have to agree. Okay, but you do need to have 2 of these components to arrive at your big picture perspective. Okay, in other words, our grand scheme of things, our big picture perspective, okay, is going to be defined by at least 2 of these areas of study. They have to come into agreement. It doesn't matter which of these 4 that you elect to subscribe to, but they have to come in agreement. So let's take a look at a little bit more information about each one of these 4. Okay, so again, focusing on the big picture perspective, the first thing we're going to be looking at is the macro market analysis. Now, this is really simply described as, are we in an inflationary market or are we in a deflationary market? When the markets or a currency or country is in a inflationary condition, it's going to have a direct relationship on the currency. Obviously, when they're in a deflationary market condition, that's going to have a relationship or a response to their currency. It also, in terms of equities, is going to have a direct relationship to that. So when we talk about commodities and we talk about stock prices later on in this mentorship, inflationary and deflationary market conditions are going to have a large impact on that as well. The next area is interest rate analysis. And obviously, when we're looking at interest rates, we have to consider, are we looking at higher interest rates? Have we seen a trend in interest rates? Have they been climbing? Are we looking at lower interest rates? Have we just had rates decrease? Or have we seen a trend in lower interest rates? Or did we have an unexpected change? Did something come out with, FOMC that, did a currency come out and intervene in their currency by having an unexpected interest rate change? Did they hike interest rates, or did they do an unexpected rate cut? And also, by looking at interest rates, which is not noted here, we look at differentials between 2 interest rate markets. So between a currency that has a high interest rate and another currency that has a low interest rate, many times that creates what's called a carrying charge market, where you can actually have a very easy way of finding trades directional when it has that. But again, what we're looking at, if we were just looking at these two primary areas of focus for the big picture perspective, we could have the macro market analysis. In other words, we could see an inflationary market and interest rates alignment with that perspective, and that would give us our big picture analysis. In other words, that would frame on the grand scale, are we a buyer or seller? And we want to focus primarily on that. The next area of study is inter-market analysis, and that's going to come by way of the CRB index, where we're focusing primarily on the commodity market. And we're looking at the relationship between the commodities and the US dollar index. You're going to see many times the markets between commodities and the dollar index are inversely related. In other words, if the dollar index is going up, usually commodity prices are going down. And when commodity prices are going up, usually the dollar is going higher, and vice versa. In other words, again, looking at these three areas of study, we need two of these areas of study to come in agreement to arrive at our big picture perspective. Okay, we could see a interest rate market indicating that there are lower rates on the horizon, or higher interest rates on the horizon, and that's going to lend well to a directional bias on a currency. And if we see that same time happening where the commodity market wants to go higher and the dollar index wants to go lower, that gives us a framework for a high reward trading scenario relative to the big picture. So the only thing we're doing now is framing three areas of study. Okay, and if I haven't said it already, what makes a high reward trade setup is if your big picture perspective, your intermediate perspective, and your short-term perspective is all in agreement. Okay, directional wise, if you want to be a buyer or seller relative to those three perspectives on the marketplace, if those three are in alignment and you trade on that side of the marketplace, that is high reward trading scenarios or setups. And the last and the four is seasonal influences, and that is obviously, speaking on terms of, are we in a bullish seasonal tendency for that asset class or pair or currency, or for the dollar for that matter, or commodities. If we're studying commodities, there's a large seasonal influence that has an effect on commodities, and if we see that, obviously that's going to be mirrored in what we see in the dollar index. Okay, if the CRB index is entering a time when commodities as a whole usually go higher, that's going to put downward pressure on the dollar. So if there's going to be downward pressure on the dollar, that means that we can see easy buy signals in currencies that have interest rates that are going higher, and that chasing of yield, okay, with the currency makes a high reward trade setup. And obviously there's bearish seasonal tendencies as well. But when we go forward in the mentorship, we're actually going to be breaking down what specifically frames a inflationary market and a deflationary market, and how to go in and look at interest rates specifically, and how to use the interest rate market for timing. So it gives us a stage on when this criteria is in place, what we do with it. When should we be buying or selling relative to the interest rate analysis that we see. And the same thing with intermarket analysis and seasonal tendencies. The next area of focus is obviously the intermediate perspective, and that is by way of looking at a top-down analysis, commitment traders data, and market sentiment. And for intermediate perspective, there's only really three things that you're looking for, okay, but at least two of these things have to come in agreement. So that means by looking at these three specific components, okay, top-down analysis is simply just looking at higher time frames down to a lower time frame. And COT, again, if you're not familiar with that is, it's commitment of traders data. What we do is we look at the CFTC report that comes out every week, and it gives us a reportable level report on large commercial traders, large speculators, and obviously the small specs. We're not really so concerned about small specs. Small specs would be somebody like ourselves. We're trading in unreportable levels. In other words, we don't trade at a level where we have to report our trade size, which is mandated by the CFTC. At least in the States it is. And market sentiment is simply I use Market Vein, okay, which is a measure of brokerage firms actually calling around and getting a consensus on whether they believe a particular market is bullish or bearish, and it's basically it's an opinion. You can use other things like there's certain websites out there that have a bullish or bearish an opinion. Like if you go to barchart.com and you pull up a specific commodity, you can actually see what the community at large in that forum has for that particular that view. I think there's pretty much just about every forum out there has a way of measuring sentiment, and I do a lot of research on Saturdays with that perspective alone. I go through a lot of resources and I actually show you where I go and get all my sentiment numbers. But it's, again, this teaching is not going to teach you everything about every individual component, but the components that we're talking about specifically, we're laying down a foundation, because it's important that we know where our study is going to be focused going through this mentorship, and why it's not a lot of information, but it's a little bit of homework that's needed for you to get to the decision making processes that I go through as a trader. So again, intermediate perspective, let's take a closer look at these three things. Okay, so intermediate perspective on the marketplace, framing high reward trading scenarios or setups. Okay, top-down analysis is obviously just going through a monthly chart, and we do monthly chart analysis. And what specifically are we looking for in a monthly chart? Obviously without going into great detail, because I'm not trying to teach it all here. The monthly chart is we're looking at key levels, we're looking at intermediate and long-term highs and lows. We're looking at specific order blocks, and we're looking at levels that show a clear indication of wanting to repel price higher or lower. And the same thing is said for the weekly chart. When we look at the weekly charts, we're looking at, again, a higher time frame perspective. So it gives us a great deal of framework for high reward trading scenarios, simply because of the weekly chart being, again, a weekly chart. Large funds, okay, large managed funds do a great deal of analysis on weekly charts. Okay, most of their work really comes by way of monthly and weekly, and they usually execute on daily charts. Okay, so it's important that you understand that that's the reason why the markets move around like they do. Most folks that have YouTube channels and Facebook, accounts, and they're out there trying to pretend that they're some kind of analyst or teacher. They'll be teaching with a 1 minute chart or 5 minute chart, and they lead individuals to believe that these intraday charts have some influence over price, and they don't. All they're doing is reflecting, okay, what is going to be arrived at by looking at a monthly, weekly, and a daily chart, because those three time frames are really what makes the markets move. By having these intermediate perspectives, okay, again, you have to have at least two of these areas of focus in agreement. So in other words, you could have an idea on a monthly chart that frames one of the two things that lead to your intermediate term perspective. Okay, and it could be, obviously, it can be off the weekly chart, or it could be the daily chart. Okay, but that would be one of the two that's necessary to frame your intermediate perspective. The next area of study would be a COT data. Okay, that's obviously looking at the bullish hedging by smart money or the commercial traders, or the bearish hedging by the smart money. And again, if you haven't watched any of my free tutorials, there's teachings on commitment of traders. It's important to know that you'll learn everything you need to know about COT data in this mentorship. So even if you haven't watched the videos, okay, or are familiar with commitment of traders, just settle down, relax. Please don't send me a Twitter storm of questions or emails, because everything I'm talking about here, I'm laying down a foundation. Okay, these are the things that you need to be starting to write down in your notebook, because there's going to be areas in your notebook that you need to have specific notes relative to these things. Okay, and I will give you everything you need to know and more. Trust me, but I'm just giving you the foundation of where our study is going forward. Okay, going into this mentorship. And obviously with the COT data, we look at extreme levels historically in the last 12 months and the last 4 years. When the commercials on the Commitment Traders report get to a 12-month extreme, higher or low, in other words, if they have a real extreme high reading or low reading relative to the net sum zero line that's used for the COT net traded position chart, which you'll learn all about. that usually sometimes indicates a change in their hedging program, and it gives you a real clear indication of there's probably an intermediate term or long-term high forming. And the last is market sentiment. Obviously, we're looking at extreme market bullishness or extreme market bearishness. And again, that's one of the things that come by way of my Saturday studies. I go through all of the things that lead to my opinion or my own individual market sentiment readings based on a number of areas. I go and look for readings, and then I get an average of that reading and come away with a consensus whether or not we're either at a bullish or bearish sentiment. Now, again, out of these three, you need to have at least two of them in agreement. The least of significance is obvious the market sentiment, but the main thing is the top-down analysis. You have to have a level or an idea relative to the monthly, the weekly, or the daily. It does not require two of those time frames. It just needs one. Okay, you can trade really without the monthly, weekly, and daily chart and trade on a idea relative to the commitment of traders and sentiment. Now think about that. You're probably thinking, wait a minute, Michael, when you say we got to use a daily chart, we got to use a weekly chart, we got to use a monthly chart. Yeah, you can, but you can still use the commitment of traders data information I'm going to provide to you and market sentiment to frame your intermediate perspective. Now, obviously, we're not executing on an intermediate basis, but it frames your trade idea. You need one of two out of these three to come in agreement with your intermediate term perspective. Now, I know what some of you are already thinking. Well, what if I look at a monthly chart and it tells me that this is bullish, and the weekly chart says it's bearish, and the daily chart is bearish, but the commitment trader says it's bullish, and market sentiment is extremely bullish? Okay, what do I do with all that information? How do I arrive at that? That's all going to be taught to you in the mentorship. But the main thing is this criteria is what we'll be using going forward. So that way, when we look at the market in these views, you'll understand why I'm doing what I'm doing, because it's based on the things that you're seeing here. Okay, so again, just know that to have the intermediate perspective outlined, you have to come to an agreement that at least two of these areas of study or focus for the intermediate term perspective, you have to come in an agreement with two of them. In other words, you either have to be a buyer based on two specific areas of study here out of the three. Okay, so again, as an example, the weekly chart indicates higher prices, and commitment traders suggesting that there's bullishness on the stance of the commercials. That would be enough to frame a intermediate term perspective. That means you're going to simply wait around for a short-term perspective that lines up with buying, and that's really all we do here. That's all we're doing. Okay, so we're going to frame a macro big perspective, okay, and then an intermediate term perspective, and then a short-term perspective. And that's what we'll look at next. Okay, so for short-term perspectives, we're going to be looking at the correlation analysis, time and price theory, and IPTA, which is, again, interbank price delivery algorithm. So take a closer look at this short-term perspective. Okay, so right away there should be something staring at you that now all of a sudden we have to look at three things to arrive at our short-term perspective. And the reason why is because most people just look at a 1 minute chart or a 5 minute chart and says, okay, well, this is all I need. And that's what gets them in trouble. Okay, so when we look at short-term perspectives, okay, we're going to be looking at the correlation analysis. And then again, that is going to be linked to your understanding of the US dollar index, SMT analysis. And I know that probably went way over your head if you're new. If you never went through my free tutorials, that probably sounds like something you hear from NASA. But the dollar index SMT analysis is basically just looking at the relationship between the dollar making higher highs, a relationship between a currency to the dollar, like the British pound, for instance. If the dollar is making higher highs, if the British pound versus the dollar fails to make lower lows, that's a cracking correlation, and we view that with a specific idea in mind. And the other correlation analysis concept that I use is correlated pair SMT analysis, where we look at closely correlated pairs like, for instance, the euro dollar and the British pound dollar, because usually they move in general same direction. Not always, obviously, you can see with the Brexit issue. Generally, when there's a symmetrical market, which we learned about in this mentorship already, correlated pairs move in tandem. When they do not move in tandem, that obviously gives us a lot of insight in terms of how we should be trading the marketplace. If it is not moving in tandem, then obviously that's indication that we do not have what? A symmetrical market. So that means we have to be very selective with our trades, because now there is the lack of symmetry in the marketplace. That means the dollar is very clearly moving higher. All foreign currencies are moving lower in sympathy. The next area of study is time and price theory. Okay, and so in time and price theory, we're looking specifically at the quarterly effect. That means every 3 months or so, there is a new price shift in the higher time frames. In other words, if the market's been going higher, generally you'll probably see the market go into a consolidation over the next 3 months. Not for the next entire 3 months, but over the course of 3 months. If the market's been going higher, you'll probably see the market go into consolidation or reverse. Okay, and if the market's been going lower, okay, over the next 3 months, we may see a consolidation and go into a range, or it could reverse and go higher. We're watching the market over. It's usually a 3 to 4 months, so I'll allow a little bit of overlap in terms of calendar months. It's not specific daily. So I'm sorry, it's not specific to the first of every month to the end of the last day of the third month. It's not that clear cut. So we look at the market with a quarterly perspective and allow the next shift in market structure to unfold. There's a monthly effect where we look at the monthly ranges and we look at specific points of reference relative to the monthly chart. And then obviously the weekly range, most of you know about that because I teach a lot in my free tutorials about one shot, one kill setups, which I think is that's like my bread and butter go-to. That's how I define my own trading. I am a weekly range trader by far and large. That's usually how I'm trading the marketplace. I'm looking for capitalizing at least the lion's portion of what I interpret as the weekly range that may unfold for the week ahead. And then obviously the daily range. Daily range is the time and price theory that we use for engineering the daily range, the power 3. The open, high, low, and close, how that transforms into the actual daily candle. Those theories and ideas and concepts will teach a great deal about that. And then obviously time of day. We'll build on what's already been shared in the free tutorials, and you'll actually have really precision-based concepts as it relates to that. And finally, IPTA, which is the interbank price delivery algorithm, will be nailing down institutional order flow. We'll understand, obviously, by looking at liquidity. We'll be looking at how the market seeks liquidity, and we'll be finishing up our perspective on market efficiency paradigm. So when we are looking at the short-term perspective, we require 3 things, okay? 3 things must come by way of these 3 areas of study: correlation analysis, time and price theory, and the IPTA. Preferably, you have to have at least one from each. Okay, so in other words, you have to have your dollar index is giving you an indication that it's showing you a crack in correlation, or correlated pair SMT is giving you insight. Okay, so that would be one way of determining correlation analysis. The next area is crucial, time and price. You have to have something from the time and price theory to indicate where you're at relative to the short-term perspective. Now you're probably thinking, okay, well, how is a quarterly effect and a monthly effect or a weekly range a short-term perspective? Because short-term is what you're actually going to execute on. Okay, it doesn't mean this is your 5-minute or 15-minute setup. It's just this is your short-term perspective. So we're looking at framing the ideas of trading around a big picture perspective, an intermediate term perspective, and a short-term perspective. When we get things in alignment that lead to us being a buyer all across those 3 perspectives, being a big picture perspective, an intermediate term perspective, and a short-term perspective, we are highly prepared to find high reward setups to be a buyer in those conditions. It doesn't mean you're going to have no losses and you're going to have all winners. It doesn't mean that, okay? But we have a context that we frame our ideas of trades with that model, or at least that's how I do it. So that's why you're here. You want to learn how I do it, so this is how I do it. We can have the correlated analysis give us a indication that we're going to be bullish on dollar, which would be bearish on foreign currencies. And time and price theory, okay, quarterly effect, maybe we've seen the market moving higher, okay, in recent months, and we're probably getting ready to go into a down cycle, okay, and that would lend well to being short on foreign currencies. Maybe the weekly range, okay, maybe we have initially at the beginning of the week we've rallied up from Sunday into Monday, and now we're primarily looking for what? Lower prices. And if we see that weakness on the part of foreign currencies relative to what the dollar index is suggesting, okay, these are all scenarios. I'm giving you just an idea because some of you are probably thinking this is too vague, this is not helpful. Okay, believe me, this is what really trading is all about. You're doing all these things behind the scene. The very little bit of time that's used to execute trades, okay, that's so tiny. The most of your time is actually going to be in the process of deciding whether or not you should be a buyer or seller and what frames that criteria. And obviously time of day, are we in a time of day where it's conducive for the trade to set up? Okay, we may not have anything immediately off the quarterly effect or monthly effect or weekly range or the daily range, okay, but the time of day may indicate that now suddenly there's something that we could do. Okay, and obviously IPTA is always going to be essential. Understanding institutional order flow and understanding where liquidity is and why the market will seek that liquidity. And our perspective is always with the market efficiency paradigm. We look at the marketplace in terms of where are the orders, and it's not the orders of the smart money. Okay, like supply and demand tries to teach. They teach you that this is where smart money orders are, and this is where smart money wants to go back to. They're not always doing that. They're sometimes seeking where existing orders are that would allow them to engineer counterparties to their execution. Okay, so in other words, they'll run old highs for the buy stops, they'll run old lows for the sell stops, because that will be a forced injection of liquidity to be counterparty to their bookmaking. So we're going to go forward in our studies in this mentorship with a great deal of refinement on all of these things. And I know some of you probably looked at this and said, well, this is a lot of just boring information, but I have to give you a context of where our area of study is going to be. So in the grand scheme of things, we're going to be breaking the market down in these specific perspectives, and then what we do in these respective areas of study that give us what we're specifically doing on a day-by-day basis. Now, it looks like, and I've been talking for a long time, it looks like a lot of information and a lot of things to do before you come away with, okay, I'm going to be a buyer or seller. You'll see, obviously, the big picture perspective. You usually have that at the beginning of the week. And the intermediate term perspective, you usually have that at the beginning of the week too. It can happen or change gears in the middle of the week relative to Tuesday and Wednesday. But usually the short-term perspective, that's the one that usually changes on a day-by-day basis. Okay, so understand that while we're doing a lot of our homework in the big picture perspective and the intermediate-term perspective, and we can do that on the weekends, your nightly or daily procedures will be largely in this list that you see right here. So when we do like live sessions, okay, I'm operating from this scale right here. I'm looking for 3 things that come in agreement, and that's why when I call a specific move in the marketplace, they usually go there. And I'm using this right here. They are all linked to my understanding of what I arrived at for my intermediate term perspective and my big picture perspective. Okay. But once you understand price action extremely well and you operate as a scalper, okay, and I'm not trying to induce the notion of scalping as an ideal way of trading, but I know some of you are going to take my information and do that invariably. You can just use what you see here, and you could be a very efficient scalper if you understand what is being shown here and what specifically that we do with this information. You know, understanding what the quarterly effect is, what the monthly effect is, the weekly range, daily range, and time of day. Understanding what SMT divergence is and correlated SMT divergence, understanding what that crack and correlation means for you as a trader, and then obviously understanding institutional order flow, where's the stops, and why those stops would be necessarily up for grabs. Why would the market go there? That's what the market efficiency paradigm is. So again, this is the only thing that you need to be worrying about in terms of trade plan development for the ICT mentorship. All of these things come by way of very, very short amount of time looking at price, and you'll come away with what you want to do right away. And initially, you're going to write down these things. Okay, I believe that the big picture perspective is, I believe that it's going to be this, this, and this. And then you're going to go into intermediate term perspective. You're going to come away with your analysis on what you believe there. And when you see the short-term perspective, you go through the same processes here. Basically, what you saw me doing, with the exception of not bringing out the SMT divergence studies in September, because I was looking at it, but you just didn't see it. I was operating on this short-term perspective. This is my model. Okay, so as a day trader, as a short-term trader, and as a one-shot, one-kill trader, this is all the information I need. I don't need anything else outside of this page you're looking at right here. I just need 3 things to come in agreement with that, and then I'll understand where the short-term perspective is and where the market's going to go. And that's why I'm like 90+% accurate. In the month of September, we pretty much had a 100% hit rate on everything I asked the market to show us in terms of where it was going to go and why it would go there. It's not always going to be that easy. There's going to be transitions, obviously, on an intermediate term basis and even a long-term basis. And that will cause you to have hiccups, okay, or speed bumps, if you will, or barriers, okay, on these short-term perspectives. And that's where the losses are going to be. You're going to find that your losses are not incurred so much by way of trading in the intermediate and long-term perspective, the big picture. When you're trading in those higher time frames, those trades generally will serve you very well. You will still have losses, but you're going to find that all of your trades that have the majority of the losing side, it's going to be because you're in this short-term perspective and you either force something or the market's in transition and you have to allow for that. Okay, so if you're focusing on a higher time frame perspective in your trades, that is an advantage. So while we see me operating a lot with the 15-minute time frame and the 4-hour and 1-hour chart, the things that we talk about are largely on the weekly and the daily chart. And if we do that primarily in all of our trade setups, requiring a big picture perspective, intermediate term perspective, and a short term perspective in alignment, in agreement, that means all 3, we come away with a reason for expecting that outcome. In other words, higher prices or lower prices. Think about what we have here. We have to have 7 things in agreement to make a high reward trade scenario. Okay, for a high reward trading setup, it has to be 4 things in agreement. That means you have to have 2 things in agreement from the big picture perspective. You have to have 2 things in agreement with the intermediate term perspective. Then you have to have all 3 that's listed here. Okay, you have to have 1 from each one of these 3 to come in agreement with all 3 perspectives, the big picture, the intermediate term perspective, and the short term perspective. And if you frame your trades with this mindset, what that does is, number one, it gives you clarity. Number one, it gives you understanding of what it is that you should be expecting to see in the marketplace and why, which is important. Okay, it's not important to understand every dynamic behind what's being shown here for each perspective of the marketplace of study. That's going to be taught to you, but understanding that you need to have 7 things, okay, 7 things that build high reward trade setups. This is not execution. This is not entry. It just gives you the framework, what makes that trade high probability or basically high reward. You still have to wait for a entry signal. And again, that's the least of your concern right now. So that's what I'm saying. By looking at this information like this, even without going into great detail about each individual component, you can see clearly that there is a method behind what I do. Okay, folks that are on the outside, they look at what I do and they say, well, there's no real structure here. There's no real plan of action. There's no way of knowing what it is that I should be doing from the beginning to the end. And that is because they have not been exposed to what you're being exposed to now. There is a method. There is a rhythm. There's a routine that you go through. But they have to come by way of a process-oriented thinking. And this is how I break the market down. This is how I internalize it. And I go through the process of going through these 3 perspectives, and by doing that, it gives me everything that I need in terms of arriving at a decision. And once you have that same process of thinking, Okay, you'll have no problem going through the marketplace, finding scenarios and setups, and then picking out what gives you your unique trade setup that you like to trade, that you find very easy, and the clarity will be exactly as you imagined it would be. And when you get in front of the chart, it just jumps off at you. Okay, that's how it'll be for you. As a new trader, you don't get exposed to these types of thinking. You don't get exposed to these process, procedures where you have to look at things conceptually. Because number one, it doesn't sell courses. It doesn't make you want to watch that YouTube video. You don't want to listen to this one. Okay, but this is where the real meat is. Okay, you have to know why these things make a difference and why it's important that you understand what you need to be doing for individual perspectives of study. And then once you go through it and you understand it, it's like anything else. No one wants to read the driver's manual to learn how to drive. No one wants to look at the instruction manual on how to put that TV stand together that you had to buy because your wife said you had to have it. Okay, and you just want to look at the parts and fit it together so you can quickly get through it. You can't do that with trading. Okay, you have to go through this boring stuff, and it means a great deal, trust me. If I would have been told this initially, I would have ignored it too. I would have just pushed it aside, and I would have been looking for, give me the buy signals and give me the sell signals, because that's how I thought too. Once I felt the pain of not knowing what I was doing, then I suddenly got interested in what makes traders think the way they do. And then what's the process of why they think the way they think, and why do they build their trading plans around that? And you think about it. What do you not see in the marketplace? When people sell things and they sell courses and stuff, what is it they don't sell? They never sell you an actual trading plan. They never sell you a step-by-step, this is what you're going to do, and this is the reason why it should do this. No one does that. That was my goal for this mentorship. I want to show you what specifically I do as a trader. Now, I'm going to give you all kinds of ideas on how you can refine that and make it uniquely yours. And you can define your own trading model around that. Because I believe, just like Chris Laurie has said, and I was in agreement with him when he said it, you can't copy someone else. You can't do it. And some of you want to be just like me as a trader and do this and do that. You're only really asking to be able to call moves and trade to the levels like I call in advance. So it's not that you want to trade like me. You want to have the ability to read and interpret price action the same way I do. And that's what you bought and paid for, and that's what you're going to get as a delivery. By the end of this mentorship, you're going to have everything that I do. Why I do what I do and how I arrive at that understanding is what has been shown here. There's no secret sauce. There's nothing outside of what's been shown here. The theory behind why they all blend together, okay, that's what we'll be building on. And at the end, once we understand intimately what each one of these perspectives we're looking for and what criteria lends well for the decision-making process for each individual perspective and individual respective component, once we have that, then we have the building blocks for what? The flow chart for every model of trading that there can be. Day trading, scalping, swing trading, one shot, one kill, position trading, all those things. It's easy for me to have a flow chart and say, okay, XYZ, do this or do that. You'll know what I mean by that. And that's why I said, if I put the flow chart up on the website right now, you wouldn't be able to do anything with it. It would be no use to you. You couldn't do anything with it. But by breaking down these individual components intimately, you'll know what I mean when I say, okay, do this or do that. Okay, well, I understand what that means. And then I know how to arrive at the decision relative to those specific points of reference. And then by doing that, you'll work through the flow chart, and you'll either come to the decision point where you take action, or you stand and you wait for more information, or you go back to the previous stage and you wait for more information there. And it makes it very binary. You need your trading to be just like that. It's boring, and that's exactly what you want. You do not want high excitement in your trading. Only do that on the weekends when you had a really good smashing week, when you just killed it. That's when emotions are allowed. But throughout the week, when the markets are still trading, you cannot allow your emotions to get ahead of yourself. You can't get crazy. And you want your trading to be boring. You want it to be monotonous. You want it to be mundane and routine and nothing exciting about it. That's when you know that you're not going to be forced by emotion. You're not going to be drawn in by fear and greed. It's just business as usual. It's the same thing all the time. and you hear it sometimes when I'm talking, I'll talk about a specific level, the market starts screaming for it. I'm still talking, I'm not worrying about it because I've seen it so many times. The whole time the room is lit up. They're like, I can't believe this is happening. Look how it's moving. Look, it went right to the pip. You're all experiencing that for the first time, especially in December. Everyone that was watching on a day by basis, that's not something I get excited about unless I see a real new trader. When they get in there and they start looking at it and their response is, then I can get to relive that moment. But when we go through the process of breaking down the markets and we're looking for high reward trading scenarios, you have to suppress that desire. Don't be in a rush to get to that feeling of you were right and look at the market. Don't do that. And by having a process-oriented thinking, you're thinking binary. It's X or it's O. It's on or it's off. It's black or it's white. That's how your trading has to be. And if you can work your trading model into that area of study and execution, you will have no problem with fear and greed. You won't rush. You won't have any issues at all. And just like we mentioned in the previous teaching, if you have a loss, there's no reason to worry about it. It's very easy to get it back. And even if you have a string of losses, it doesn't take long to recoup that. But if you lose your mind, okay, thinking all of a sudden the markets are not going to work like this again, there's no reason to think that way. You'll see by the end of this mentorship, you'll know everything you need to know and how to operate and execute and engage the marketplace on a day-by-day basis. And you'll know what exactly you're going to do and why. But it comes by what we just described here in all the framework that's been shown here. Nothing outside of this, no secret stuff, okay? Everything refined to great detail, minute detail. And then what that'll allow us to do is to have specific processes that will lend well to specific conditions that we'll talk about. And then all that will give us our trade scenarios and setups. But the ingredient behind it all is what's been shown here in this tutorial. And it's important that you understand that this is exactly what you would be wanting to know, but you just didn't know it. And it doesn't sound sexy. It doesn't make a good course. It doesn't make a good video, YouTube. If you were to just explain this, if someone was to show just a PDF file on this video, they'd be like, well, this is telling me nothing. But it really is, when we're going to build on this, it's exactly the framework or the backbone of how I trade. How I'm able to call the markets and why they go where they go beforehand. How I showed 59% in 1 month, with an IFX book for October so far. All that is because of what's just been shown here and my implementation of all that information. So I want you to understand that we're going to build on this individually, conceptually, and then once we flesh it all out, it'll be easy to be able to provide a PDF file, and you'll know exactly what that means when you look at the PDF file, why these information reference points are influential in terms of decision making. And once you have that, you'll be exactly what you signed up for: an independent thinking, efficient trading